Good evening and a warm welcome to our clients who have joined us for this evening's webinar. Tonight we have our macro analysts, Mr. Colin Low and Mr. Ong Ziang, who will be joining us, who will be sharing with us rather a brief outlook on the markets in the second half of 2020, along with an update on the MAP's portfolios and the actions they've taken over the first half of this year. So with that, I'd like to invite Colin to open up tonight's session.
Hi, good evening, everyone. So it's my pleasure here to be presenting on the update for MAPS for the second half of the year. So firstly, I'd like to begin with a global market performance review as well as an outlook. So let's diving right into a performance review for the first half of the year. I would say first half of the year is characterized by a V-shaped rebound in global capital markets, inclusive of the bonds as well as the equity markets. So overall, we see a tumultuous first half of the year where we find that the global equities as well as fixed income markets plunged more than 30 to 20 and 30% respectively. So that itself is followed by a meteoric rally from the depth of March low. And that's all taken within the time span of 2 months and at quite a record pace. So we see that globally as well, but prominently in the US. So the top performers for both the equities as well as fixed income comes from internet stocks and Chinese equities, as well as US Treasury and US IG and US high yield. So investors over the past 6 months have generally regained their confidence in markets, and largely that's due to the record fiscal stimulus as well as central bank support. So this itself has actually paved the way for a rotation towards cyclical value as well as small cap and high risk assets. So here I'm showing a performance table for global capital markets. So we'll be focusing largely on the performance for the second quarter, the first half as well as year-to-date performance. So if you look at the second quarter performance, which is being characterized by the recovery run, we'll find that the recovery occurs largely in the emerging markets, so places such as EMEA, Latin America, and also particularly in the US as well, churning in 18%. So of course, the large winner is definitely the digital economy, which we define using the OGIC index. So it have generated around 50% of the return over the second quarter. So if you look at on a year-to-date performance, most markets have actually recovered to their pre-COVID level, and some markets actually went beyond the pre-COVID level. So markets such as the US market, as well as the Asia Japan market coming in at 7.5%. And certainly if you look at China, and here we are showing China offshore, but if you look at China onshore, it has been one of the main drivers for the Asia Japan index. So if you were to look, divert our attention towards the fixed income markets, you'll find similarly the higher risk assets such as the higher yielding segments, the US high yield, Asia high yield, as well as the EM debt, which is comprised of 30% of EM high yield. You'll find similar returns of above 10%. So that is across the second quarter of this year, as well as largely better improvement for the year-to-date performance. So here I'll present our views on the global equity market. So I'll split that into the tactical near-term view, as well as a longer-term picture. So here for the near-term view, we do believe that we see there will be near-term tailwinds that can lift the markets higher. And these tailwinds are being carried over from the first half of the year. So we see optimism and risk-on appetite continue to build. And also we see elevated levels of liquidity as well as a greater inflow from retail as well as institutional investors. So here I have two charts. So the chart on top shows the change in central bank balance sheet since all the way since 2008, June 2008 to June 2020. And you see, especially in June 2020 or a couple months before June 2020, around April and May, you see the spike in balance sheet expansion. And so that itself has driven a lot of optimism as well as a risk-on appetite. And if you see the chart below, which is the money market funds, and the total assets within the money market funds actually surpass the GSE level by quite a bit. And this we believe that this total assets within the money market funds is that it might be able to be deployed in the second half of the year, and therefore might see greater inflow from retail as well as institutional investors. But overall, if you look at the flip side of stuff, we look at the risk, when we find that the risk itself are actually mounting in the second half of the year. So risk largely comes from three areas, we believe. So first area is the US election as well as the related risks. So we characterize the related risks such as the trade tension as well as the fiscal cliff. So the second key risk we see is a severe second wave that will lead to a rolling shutdown. So this possibility is still floating around, but as of current, it is still not materializing, which is a good thing for the asset market. And overall, we see another risk coming from the slowing of stimulus measures. And like I said before, stimulus measure has been the bedrock of confidence for investors, and so a slowing of this stimulus measures could slow the valuation expansion in many of these equity markets, especially the US. And overall, if we to put all things together, we'll find that in the second half of the year, we see more risk per unit reward, and that is compared to March as well as the April period. So what we recommend is selective buying, and as opposed to broad-based buying of equities. So the strategy on hindsight, the strategy, if you look at March as well as early parts of April, is to buy the laggards, and those strategies that we think is hard to apply in the second half of the year. So from a longer term strategical perspective, we see and we do believe that growth needs time to rebound back to pre-COVID level, and we expect a move to a cyclical economic expansion in the next year. So if you split the growth up by different regions, so denoted by my chart on top, you'll find that growth, particularly in China as well as broader Asia, so Asia ex Japan, you'll find growth to be stronger, and growth in this region, especially in Asia, should recover to pre-COVID level earlier than its peers. So that's one of the main reasons why we still believe in Asia and still maintain our overweight position. And if you were to look at the other side of stuff, look at the inflation levels, we find that reflation, and we believe reflation should follow the next year, and that is due to the copious amount of money printing as well as the gradual rebuilding of lost demand that's being killed off by the waves of lockdown. So if you were to look at Japan on the chart below, you'll find Japan being in such a more of a tight position, facing more of a deflationary headwind looking ahead. So there's also one key reason why we have turned more negative towards Japan, and that will be explained by my colleague later on. And overall, if to pair both outlook together, so a decent level of inflation as well as economic expansion, we believe overall will be a potent positive for equity markets historically and over the coming few quarters. So the longer term outlook for equity markets, as we believe, is more constructive. So moving on to the fixed income markets, we think that the name of the game in the second half of the year is definitely to have a fine balance between defensiveness and selective positioning. So defensive positioning via your government bonds such as the UST as well as the IG bonds are still important in the second half of the year. And that is likely due to a greater likelihood of event-driven risk. So the risk, like I mentioned earlier, and overall the yields for these higher quality segments, we believe are likely to remain range-bound for 2020. As we all know, the lower interest rate will be here for a longer period of time. So we are unlikely to see rate hike coming from major central banks for the next 1 or 2 years. So with that said, it sets for a very attractive turn towards riskier, higher yielding segments. So, but we, at the same time, we advocate to be very selective with these riskier, higher yielding segments. So our goal here is to enhance total return without forsaking too much of a risk management. So overall, if you to look at the higher yielding segments from my chart on the right side, you'll find that the higher yielding segments coming from EMs, coming from Asia particularly, offers a greater spread, offers also a greater yield level. So with that said, we think that these are signs of an attractive entry point for these two sub-segments of the fixed income. And overall, if you look at the longer picture, we'll find that the drivers for higher yielding segments are actually materializing. So firstly is the hunt for yield, and secondly, the building of the risk-on sentiments, and thirdly, the great bond carry demand that's building from now onwards. So moving ahead, I will be talking about the portfolio as well as the fund performance over the past 6 months. So firstly, diving into the different portfolios, focusing on the growth portfolio first. So the data is as of last week, so as of 28th of July. So as you can see from the month to date as well as the 3-month performance, we have largely outperformed the benchmark. So the greater outperformance comes from the aggressive as well as the moderate aggressive portfolios, and it tapers down all the way to the conservative portfolio. So where we lag behind the benchmark is for the conservative portfolio and largely confined within the horizon of the 6 months horizon, the 6 months investable horizon, as well as the 1 year period, and definitely the year to date period for the conservative portfolio. But overall, if you look at the performance since inception, and also to this year and earlier, we'll find that we're actually catching up to the benchmark. So if you look across from the right to left, especially for the more aggressive portfolios, you'll find that the gap between us and the benchmark, which we are initially lagging behind, is actually closing, and now we have went beyond the benchmark. So I think that is largely applicable for the income portfolio as well. Although the income portfolio perform less positive than compared to the growth portfolio because of the nature of dividend distribution. And overall, we find that this trend of catching up to the benchmark is being observed within the income portfolio as well. And also the outperformance in terms of the nearer period denoted by the month to date, the 3-month as well as the 6-month period. So here I have the portfolio performance across the second quarter. So I've included the March drawdown. So here, this is for the growth portfolio. So across the growth portfolio, we can see that roughly the March drawdown is around 10%. So that is so for the aggressive, you look at compared to benchmark, the benchmark is around, I believe, down minus 10.6%. So you see it's roughly in line with the benchmark, whereas the conservative portfolio, the drawdown for the conservative portfolio is more than the benchmark, which is around 3 to 4%. But however, if you look at the recovery of the portfolio across from April all the way to July, you'll find that you actually beat the benchmark. So just to give an example, for one of the best months, which is the month of May, if you look at the benchmark of how much it has actually rebounded in May, you'll find that for aggressive it rebounded around 3 to 4%, whereas you'll find that even for conservative all the way to aggressive portfolio, yes, also our portfolio rebounded above 4% compared to the benchmark of around I believe it's 0.9% for conservative all the way to 4% for aggressive. So I mean, similar things can be said for the income portfolio, but for the reasons I mentioned before, the income portfolio is lagging a bit in terms of performance as compared to the growth portfolio. But overall, you can see the signs of a strong recovery largely applies to the income portfolio. I think a large reason for that is because of our allocation, of our overweight allocation towards Asian equities, as well as our allocation towards digital economy. So all in all, those actually help push up the recovery performance of those portfolios. And also, if you look at the fixed income portion, we find that our portfolios have a larger allocation towards the higher yielding fixed income section. So that itself has actually helped us in the recovery process, because those are, like I said earlier on in my slides, those are the areas which have actually rebounded the most within the fixed income segment. So moving on to the individual equity funds. So I would like to highlight firstly is our selection into Lake Mason ClearBridge US large cap. So I mean, this selection of funds since last year has actually helped us a lot, both be it in defending against the drawdown as well as the recovery. So I think a lot has been said for the digital economy as well as some of the larger players. So those are the players that are included inside the large cap growth fund. So those are the players at the same time that help us to bring up the performance of the portfolio. So within the European fund choice, we find that the dividend funds are actually lagging behind the growth funds. So if we were to look particularly for the 6 months period as well as the year-to-date period, you'll find the lag quite obvious. And I think despite being able to chase, despite a better performance over the 3 months as well as the 1 month period for those dividend funds, the broad lag between the income versus the growth portfolios can be attributed to the larger allocation, or rather the allocation towards this income funds that has been dragged down, has dragged down the performance by a bit. So moving on from the European region, we find that for Japan itself, the dividend, our Nikko AM Japan Dividend Equity Fund is actually lagged behind the benchmark. I think this is a reason why we are looking for a future change for this fund, and because when during the drawdown, this fund has actually performed quite well because of a dividend strategy being more defensive during the drawdown. But since the recovery, we believe that the selection should be tilted towards a more of a growth fund for Japan's case, and we're definitely looking to make a change in the near term. And lastly, we have the OGIC fund. So talk quite a bit about this fund. So this fund has been have been churned out quite a stellar performance over the last 6 months, and definitely helped our portfolio perform even better than the benchmark. So moving on to the EM equity funds, and overall, I think we are quite satisfied with the performance of the Asian funds, and despite the dividends funds lagging a bit, the overall performance is still decent and across a different horizon, and therefore we have no issues regarding the choices of the Asian funds, be it a dividend or as well, or the growth funds. And I would like to just mention on the EM funds, the LATAM fund, as well as the EMEA funds. And we'll find, in particular, these funds have actually outperformed the benchmark when there's a cyclical recovery, and largely underperform when there's a drawdown. So our intention is to keep this fund because we believe we'll see much cyclical tailwinds for the EM markets moving ahead, and therefore should benefit from any upside from these funds. And lastly, which is the Fidelity China Focus Fund. So broadly, during the drawdown, this Fidelity China Focus Fund has performed worse than the benchmark, but because of its heavier tilt towards the financials as well as the industrials within the Chinese equity. But overall, because of its composition of its fund as well as certain other reasons, which my colleague will talk through in a bit, we have decided to look in detail and propose a change for this fund. So I will leave that explanation to my colleague in a bit. And lastly, for our tactical allocation for the equity funds, I think we are quite satisfied with the performance of the CQQQ, which is the Invesco China Tech, as well as the VanEck Vector Semiconductor ETF. So across the different periods between the 1 month as well as the 1 year period, we'll find that performance of this fund performance of this ETF has outperformed the benchmark, and generally we're quite happy with that, and we continue to be positive on these two areas. So where our conviction has changed comes from the BMO Hong Kong banks, which I will leave it to my colleague to talk you through why we decided to make certain changes regarding this ETF. So moving on to the fixed income funds, I think broadly we're quite satisfied with the most of the funds, especially the Asian funds. And I'd like to just highlight on one fund, which is the Asian High Yield Fund. So for the IG segments, the safer segments, we are quite happy. But for the higher yielding segments, we believe that the Allianz Dynamic Asian High Yield has continued to underperform the benchmark for a longer period. No doubt it's a recent outperformance in the past 1 month, and as well as the 3-month period. But moving ahead, we are looking towards making certain changes to better our fund selection within this category. And just to conclude things from the fixed income funds, we continue to express our positivity with regards to EMD as well as the Asian High Yield segment in general for the reasons I've stated. And we believe the larger room for spread compression as well as higher yield coming from this area are key motivating factors for us to be positive on these two sub-segments. And at the same time, we remain positive on the funds that we've actually chosen for this particular allocation. So with that said, I should pass on my time to Tze Yang to take you guys through the second part of the presentation.
Thank you, Colin. So, So my teammate, Colin, has actually shared quite a bit on how the funds have performed this year so far for this first half of the year. So I will talk about some changes that we have made across the first half of this year, as well as what changes we have made in the second half, which is I believe a majority of you guys who are MAPS holder would have received sort of a rebalancing notification that we have made on Monday. And I'll bring you through the changes as well as the rationale behind why we are making those changes to better position ourselves in this more heightened volatility environment that we expect to see within the next few months ahead. So maybe as a brief recap, I'll bring you through the portfolio actions that we have taken in the first half of 2020. More notably, in March, what we did was we actually increased our equity overweight by 2.5%. After the sort of a sell down in March, in February and March, we think that it was actually quite a good time. The markets were actually sold off quite unfavorably. But that also brings a bit of an opportunity whereby things were sold down quite unreasonably. So that's where we actually increase our equity overweight to try to get into the value trade. And it has panned out quite well for us. We have seen that earnings yield spread widened across to the one standard deviation. So we further extended our overweight from 5 to 7.5%. So as equity market became cheaper, bond has actually become more expensive. That's when we took a bit of profit off our bonds holdings as well. And that was when also at the same time, we downgraded Japan from an overweight position towards neutral. We saw mounting near-term macro risk, I think more notably because of the cancellation of the postponement of the 2020 Tokyo Olympics, which was actually sort of heralded, they sort of advertised it as something to help boost its growth. But unfortunately, it was postponed, and tourism, which is one of the key part for the service sector for Japan itself, was facing a lot of pain. And that not only just the COVID situation coming over at a very untimely period for Japan. Over the longer term, before this whole entire COVID situation, Japan was sort of mired within a very structural, long trend headwind. So we think that moving forward, it's actually still quite vulnerable to the COVID economic drag as well as earnings headwind. But not only that, we are seeing that the longer term growth driver in terms of demographic dividends and whatsoever is actually quite weak for Japan itself. So as a result, we downgraded Japan from overweight to neutral, and we shifted that allocation towards Asia ex-Japan, where we see a longer, more robust growth potential. And in April, what we did was we did something that is quite different from what out there in the market, which is something called the digital economy. And what we've seen is that in April, after this COVID situation, and with the COVID environment probably going to linger for all the way to the end of this year or even longer than that, we think that digital economy is something here to stay. And in fact, it was the trend of us shifting to a brick and mortar traditional economy towards this digital economy was already underway before the COVID situation. So what the COVID situation did was it accelerated the shift towards that trend, if any. A lot of those traditional brick and mortar stores that we have seen that were struggling to survive has over the last few months, if you guys have keep track with the news, is that they have actually thrown in the towel, and then they have declared they either closed down their business or went bankrupt. So, and that actually, we think that was a very strong move that will continue to push the digital economy as they take on more market share from this traditional player. And what we did was we allocated 10% of the entire equity sleeve based on the proportionate size of the digital economy of the entire world. So if digital economy were to be carved out by itself on a global scale, it should account for 10% of the world's GDP. And so as a result, our MAPS methodology is that our guiding principle is that we follow the GDP weighted approach. And as a result, we allocated 10% and we initiated with a neutral position through an ETF choice called OGIG, which is the O-Share Global Internet Giant ETF. And what's so special about this ETF was that it not only include your favorite US tech giants like Google, Facebook, Amazon, but it also include those China ones like Alibaba, Tencent, and Baidu. And what we have seen on the chart on the right is that digital economy as an index, as a whole, has outperformed the MSCI World by a huge margin after that meltdown in end of March. And so this was the asset allocation, which served us pretty well, which in a way, like what my colleague has shared, Colin has shared, why we managed to outperform the bench within the last 3 to 6 months was simply because of our positioning and our overweight for our equity against the fixed income market. And yeah, so this was the positioning during then. And so with that as a context, I'll talk about the latest changes we have made. In fact, this rebalancing that we have initiated was actually just on Monday itself. So it was just 2 days ago, and it's quite fresh. The portfolio actions that we have taken in the second half of 2020 so far is that we actually unwind that kind of equity overweight of the 2.5 that we took in March. We brought it down back to plus 5% equity. We are still overweight equity over fixed income because we think that the returns from equities is still a lot more attractive than the fixed income asset class. But we think that it's actually quite a good time to reduce some risk exposure given the fact that a lot of risk is mounting. The US-China trade war, the US election is 100 days, below 100 days, where if Trump did not win the election and actually failed to Biden, there could be a lot of wider implication and uncertainty that will shake the market. So we think that it's actually a good time to not only take profit of our position, but also to scale down on a bit of risk moving ahead. We further downgrade Japan from neutral to underweight, and I'll talk about that more later. And that percentage, we actually move it towards Europe. Europe has been quite badly hit because of the COVID situation. But since then, it actually sort of rebounded. And what we are seeing is that the macroeconomic data, a lot of the corporate earnings conditions for Europe right now is actually better than expected. And it has to do with a little bit with its proximity in terms of business relation with China, and that the fact that China actually is starting to recover at a very robust pace after the COVID situation. It's in a way rubbed off a bit on Europe as well as, which I'll talk about it later. In terms of fund switch, what we did was we actually zeroed in 3 particular fund product choice because in terms of the geographical and inter-asset location basis, we sort of got it right. But some of the products were the one that was pulling down our performances. And there was 3 black sheep within our portfolios that we thought is actually a good time to change. One is the Allianz Dynamic Asian High Yield. We did an Asian High Yield sleeve. China, which is a China Fidelity focus. And last but not least is actually the BMO Hong Kong Bank. So the first reasoning why we actually reduced the equity overweight by 2.5%, of course, what I explained was because of the heightened volatility as well as increased uncertainty as in the next few months. So what we thought was it's good time to reduce some risk as well as to take some profit off our position as well as our overweight, severe overweight position that we have taken since March. And we think the equity risk premium actually have fallen. It's around 4.5%, but previously when we initiated the overweight, it was between 6 to 7%. It's decent, but it's actually not that attractive. That is not extremely attractive like what we have seen back in March relative to history. And risks are mounting. That has sort of skewed the risk reward profile. We're seeing more risk per unit reward in the second half versus the first half. The second wave of a coronavirus situation across the world is still sort of simmering. It's being held under control because a lot of the economy remains in a shutdown position, say for example like Singapore, Hong Kong, and around the world. And if the second wave were to come and hit on a very severe end, we think that there's actually potential for further shutdowns and maybe a further more severe measures, social distancing measures that can continue to hurt business. And like what my colleague has mentioned, a lot of the massive stimulus measures that the governments around the world has implemented to help companies across the first half of this year is starting to wean off. And not only that, a lot of these, I think a lot of policymakers did not expect the whole coronavirus situation to be such a prolonged one. So if you look through across the world, especially in the developed segment, developed nation, their toolkits or their ammo to continue is actually starting to run out. And they are starting to be a little bit more conservative because their ammo is running out. And ahead, the US election is only less than 100 days away. So what we are saying is that because of that, and with Donald Trump, President Trump, of course, using a lot of the trade tariff and to sort of rally its base, we think that there's actually a lot of uncertainty that can mount up and that can actually affect and shake up the market quite a bit. And we think that the potential, because the market has recovered so strongly after the end of March meltdown, we think that the potential upside moving ahead is not as attractive as it was in the first half of this year. We think that markets have sort of priced in the V-shaped recovery in earnings and economic growth, but the truth is a real V-shaped recovery is unlikely to happen. We think that the other half of that V will look more like a 90 checkmark shape. So it'll take way longer time than what markets are expecting right now in terms of a recovery. So we think the economic data is still pretty poor after 2 months of reopening. So the signs of previously a lot of employees were furloughed, but what we are seeing is that this temporarily is actually moving into unemployment, permanent unemployment. And this loss in income will affect consumer sentiment, will infect investor sentiment that will pose a risk on the markets. So we think that a lot of the optimism has actually already been priced into the market already. In terms of inter-asset allocation, what we did was we further reduced Japan and move it to the Europe allocation sleeve. So Japan, so this year so far, we moved Japan from overweight to neutral to underweight, while Europe is the other way, underweight to neutral now. And this is actually the latest product allocation across our portfolios after putting in after implementing the changes. So quickly going towards why we increased the allocation towards Europe was that Europe is actually pretty much successful in keeping their outbreak low after the reopening. We think that the possibility of a serious second wave of COVID infection is actually pretty low. And with these low confirmed cases, right, economic activity can actually start to rebound at a more steady pace than expected. And earnings revision that was quite drastic after the COVID situation could actually start to bottom and start to pick up from here. And the policy, robust policy responses that are coming out from Europe is actually quite robust as well. So I think one of the biggest things plaguing the whole Europe region before the COVID situation was that there was a lot of disagreement. Growth is actually slowing, but a lot of countries, not every country will benefit from, like say, for example, the biggest economy like Germany. They did not need to, they wanted to practice a bit of fiscal prudence. They did not need to implement so much fiscal stimulus or these are loose monetary policy, while the weaker countries like Italy and Spain, they needed such help. So there was a lot of disagreement whether to spend money during then. But because of this COVID situation, they have come to an agreement that for the greater good for within the region, there need to be spending. There need to be both on the monetary side and the fiscal side. So what we have seen over the last few weeks is that successfully the European nations actually come to a consensus in terms of the EU Recovery Fund. And this could be actually a potential game changer that will boost the potential long-term structural growth for the entire region itself. So with much of the negative already priced in for the Europe region prior to the COVID situation, and after the COVID situation, we think that positive catalysts are actually lining up for the Europe region itself, which is quite obvious through the more recent economic data that was actually better than expected. So we think that there's actually, but these positive catalysts are not fully priced in yet. Some of them are already being priced in, but we think that there's still quite a good ample headroom to go. And we think that this scope for positive earnings as well as a GDP growth revision is actually starting to accelerate. So we actually raised it from an underweight position of 19.1% towards a neutral of 21.6% across the global equity sleeve. And at the same time, on the other hand, Japan, things are actually getting worse off for that particular region itself. From what you see is that the GDP growth actually has started to taper quite a bit. It has actually sunk into quite a deep recession in the second half of 2020. And we think that this deep recession situation will last all the way until the first quarter of 2021. And only then will maybe growth pick back up to a more positive part. And we think that because of that, earnings are likely going to see greater headwind, and longer term sort of equity returns may be quite capped as a result. And not only that, is that performance for Japan equities has been pretty great over the last few months. And this has to do with much of this near-term upside was actually driven because of the liquidity expansion due to the accommodative or loose monetary policy through its own central bank action. So the balance, the Bank of Japan, which is Japan's central bank, has rapidly expanded its balance sheet. And as a result, that drove liquidity into the equity market, driving the performances. But what we are seeing is that much of that stimulus is starting to wear off, meaning that that kind of abnormal growth, that spectacular growth that we have seen over the last 2 to 3 months are unlikely to continue. In fact, it's probably going to start to slow. That's when people probably take profit and move out of the market because of its lower long-term growth potential. We think that the longer-term appeal has sort of diminished because of that, because of lower potential upside, but higher risk due to its weak post-COVID growth environment. So we reduced 2.5% from an underweight from a neutral position towards an underweight. So right now, within our portfolio itself, within the equity sleeve, Japan only accounts for 3.4%. So not only that, I think that coming to the fund switches, we made 3 fund switches across 3 categories that were weighing down on our performances. So the first one is the Asian High Yield sleeve. I think the Asian High Yield, especially the Allianz Dynamic Asian High Yield fund, were pulling down our performances for a long time already, not just this year so far, but last year as well. We think that the returns for the current fund has lagged its benchmark quite severely and across and peers as well, especially since because of their the conviction ideas were kind of on the wrong. So they actually placed quite a bit of overweight into certain ideas, and unfortunately, some of those conviction ideas went wrong for them because those companies, those bonds, they actually defaulted. So which resulted in their poor performance this year so far. And but the thing is that Asian High Yield is actually a segment that we are very positive on. So as a result, because of that, we need a very good product to help us provide the performance we want to. So that's when we actually make a switch towards this Eastspring Investment Asian High Yield Bond, which is actually the newly recommended fund for our Asian High Yield Bond Fund. It has better return adjusted returns and return profile than the Allianz Dynamic High Yield. And based on Asia's macroeconomic outlook, as well as the China housing market, we think that the broad fundamental for the Asian high yield corporate market remain pretty much positive. Credit fundamentals are still in quite a good shape and should continue to improve looking ahead. But right now, what we are saying is that market is not latching onto it yet. So current credit spreads are still way above average, and it's in fact one standard deviation. And we think that moving ahead, the search for yields, risk-on appetite, and demand for bond carrier will actually continue to drive prices. In fact, within the Asian high-yield bond space, it has recovered all its losses this year. And we think that the momentum is going to continue to carry on for the rest of till the end of this year. And we want to take part or have participation in this fund, this segment through a good bond fund, which is our recommended fund, which is the Eastspring Investment Asia High Yield Bond. For the second fund, is also an Asia-oriented one. This is the China sleeve. Since last year, we implemented the China sleeve as an individual part of the portfolio, and we did it through Fidelity China Focus. But however, this fund did not do that well for us. It didn't pan well for us. It's because of the fact that China Fidelity Focus actually is on the China Hedge, the Hong Kong listed equities. And unfortunately, the Hong Kong share market has actually lagged behind the broad Greater China market itself. And we think that the returns for the old funds has been lagging quite badly compared to its benchmark, as well as comparable funds within the Greater China region, due to its majority exposure towards the Hong Kong listed market. On the other hand, the UBS equity Greater China Fund, it has a wider mandate. It's able to invest not just Hong Kong, but also the China A domestic onshore market. And not only that, because it's Greater China, you'll be able to invest into Taiwan equities such as TSMC as well. We think that because of that wider mandate, it has more mobility to take on more conviction ideas as and when the market changes. And also, which is quite testament to its better risk-adjusted return so far, as well as return profile compared to Fidelity China Focus. In fact, comparing to that of a lot of its peers within the Greater China funds. And because of that, the proposed fund is also the recommended fund for the Greater China region this year. And so this is a comparison between the HSML 100, which is 100 China's company that is listed in Hong Kong, versus 300 of its domestic company, which is a CSI 300 index. As you can see, year to date, HSML 100, that's based on 28 July, is actually down 0.2%. But the domestic market actually recovered very, very strongly after sort of a small sell-off in February and March, and has rebounded. It's up about 15% year to date so far. And last but not least, this is actually our tactical idea, which we invested into. So the three best idea that we have implemented last year was the CQQQ, which is the China Tech ETF, the US Semiconductor ETF, as well as the BMO Hong Kong Bank, Hong Kong and China Bank. And when we took up this position, in this tactical position into Hong Kong Bank, was the fact that it was pretty cheap, and there was a swing to that. We think that the banks could actually swing back to value, and that will provide us with returns. Unfortunately, that didn't pan out as what we wanted it to be. The Hong Kong bank's performance, particularly for this Hong Kong bank, they had quite a bit of exposure towards the Hong Kong Bank, which is HSBC and Standard Chartered. And because of the Hong Kong situation, I think before the pre-COVID crisis, it was the racial riot, the social tension between Hong Kong itself because of the political issues with China, and that sort of that riot actually took place for 1 year, and that affected a lot on its retail and of its whole tourism space. And with the fact that Hong Kong is actually quite a popular tourist destination, that sort of weighed down on a lot of the Hong Kong stocks. And not only that, so a lot of its earnings for these particular Hong Kong banks were pretty bad. But not only that, the China oriented companies like of banks, the big four banks like China Construction Bank, ICBC, Bank of China, these companies are actually quite attractive companies. They're actually quite healthy as well. But because of the COVID situation and of course a slowdown due to the economic lockdown as well as social distancing, these big four banks, which were very healthy and were quite cheaply valued, had to take on some sort of national service national service whereby they have to lend funding to unsecured a lot of corporates which were sort of failing within China itself, and that it sort of add into their earnings as well as profit. And looking ahead, we think that because of the accommodative monetary environment by China to sort of boost growth within its economy itself, we think that the net interest, because of the low interest rate, banks are also we are seeing sustained compression in their earnings revenue because of that, due to this accommodative interest rate policy. While the rising credit costs due to rising default rates should continue to erode its earnings growth as well. So while the BMO Hong Kong Bank still remains pretty much cheap, and there definitely we still have no doubt that there could be a swing towards value, a return back to a mean reversion in value. We see very limited catalyst in that scenario happening right now at this juncture. So with that, our patience for this particular tactical idea is running a little bit thin. So we actually shift that exposure, that part of the pie, towards the VanEck Vector US Semiconductor ETF, which we think that is actually going to be quite strong. So for this year, I think the semiconductor ETF has not performed as well as but it is starting to outperform. In fact, not just the S&P 500 global equities as well as Nasdaq 100 itself, because of the fact that because the looming threat of a global recession as well as the COVID environment actually weakened demand in the very near term for electronic product, and that kind of weakness actually materialized in investors' head. But what people don't understand is that moving ahead, majority of us with this COVID situation probably going to linger for a long time, and that majority of us will be staying at home, working from home, and with this being a norm, we think that the world consumption for semiconductors will actually continue to increase. Not just in the short term because of this temporary COVID trend, but over the longer term across a lot of global appliances, like for example, your household appliances like fridge didn't used to have electronics in it, but now there's more and more electronics. And not only that, your cars also did not have electronics, but right now cars like your Tesla cars and whatsoever have ever increasing amount of silicons and semiconductors within them. So throughout this period, the chip makers were actually very minimally disrupted in terms of their operation. So we think that the fundamentals for semiconductors itself is actually picking up, but prices have yet to fully reflect that kind of improvement. So as a whole, we are actually quite positive on this sector, and we think that over the long run, this VanEck Vector ETF that has actually performed quite well for us for last year. I think it's up over 60% last year. That was one of our main contributor to our performance in our portfolio last year. We'll continue to do that this year. And so we are actually quite happy and comfortable to move that allocation towards the VanEck Vector semiconductor ETF that have yet to realize the kind of potential that we expect it to be. Yep. So with that, I've come to the end of my part. So I hope that me and Colin has provided you guys with kind of a view of what we have done and what we will continue to watch for you guys in terms of our MAPS portfolio and how we are best position ourselves to make sure that we will beat not only our benchmark or provide the best returns for our MAPS investor. With that, we have come to the end. With that, I thank you guys for staying with us, paying attention for this entire update, and we hope to see you guys again in our next quarterly update for MAPS portfolio. Thank you.